Luck and risk are two intertwined concepts that share a close relationship. They are so closely linked and exist in almost all aspects of our lives and can greatly influence the result of our endeavors. Managing luck and risk is particularly important in investment because it can greatly impact our investment outcomes. In this video, we will explore the concepts of luck and risk in investment, their impact on investment outcomes, and the investment strategies that investors can employ to get the best of both. Welcome to holisticinvestment.in. The omnipresence of luck and risk in investments. Both luck and risk are significant determinants of investment outcomes, and understanding how they operate is critical to make informed financial decisions. Now, let us look at what is the role of luck and risk in our investment journey. To better understand the roles of luck and risk, let us take two examples. One from the year 2008 and another from the year 2020. A person who entered the market in March 2020 would have likely seen significant gains as a result of the market's overall upward trajectory. Whatever they had invested would have given exceptional returns. During this mega bull run, he might have even made more return on investment than seasoned investors like Warren Buffett. While the individual may believe this success is due to their own investment savvy, the reality is that luck is likely the biggest factor. Now back to 2008. If you had entered the markets in 2008, your investment portfolio would have been red for the next few years. If the investor believes that this is what happens in stock market, always citing this as a reason, then he may get discouraged from investing further, even if they have the potential to make back their losses over time. This fear of risk can be a major barrier to investment success. Whenever we get remarkable returns, we shouldn't be over egoistic and think about whether this return can be made consistently forever and whether this is a fail-proof investment scenario. Similarly, when we lose something, we should study the risk we fail to notice and correct the same in our next investment choice. Luck in investment. Luck refers to events that are outside your control and can significantly impact your financial situation. For example, winning a lottery or inheriting a large sum from your father or grandfather. However, luck is often unpredictable and unexpected and may or may not happen the next time. While luck can positively influence investment outcomes, investors need to understand that luck is not a sustainable strategy for investing. Relying on luck to achieve your investment goals is not a sound strategy, as luck is unpredictable and fleeting. Let us consider that you invest in a penny stock that is trading at less than a rupee. You invest a small sum of money in that stock with little research and have a gut feeling that this stock is going to grow manifold. After some, say, 5 years, you see the same stock trading at a value of over 100 rupees. In essence, you would have made a bumper of 100 times on your investment. This is what we call luck in investment. But can you invest all your hard-earned money again into the same penny stock? Can we expect the same profit second time as well? Definitely not. Risk in investment. Risk, on the other hand, refers to the possibility of losing money or not achieving expected returns due to the factors such as market fluctuation, economic condition, or company's performance. Risk is a more predictable factor than luck, as you and I can analyze market trends and companies' performance to make informed investment decisions. Risk is something that is under our control. This is where rational thinking comes into the picture. We must set realistic expectation and invest according to our financial goals. Is the stock market a risky bet? Stocks can have positive and negative attributes, with some providing strong returns and others underperforming. However, the fact that some stocks perform poorly doesn't necessarily imply that all stocks are poor investments. A good example of a stock that was once a solid investment but declined in the Indian stock market is Satyam. The example of Satyam Computer highlights the reality that the stock market is not entirely black or white, good or bad. Therefore, it is crucial to perform effective risk assessment and adopt appropriate mitigation strategies to avoid such losses in your investments. Managing luck and risk in investment. Why managing luck and risk is important in investment? Before we move on to the investment strategies for managing the luck and risk in investment, let us understand why it is good to manage both luck and risk. But wait, managing risk is okay, but should we manage even luck? Yes, definitely. Risk in investments make you fearful of the market, whereas the luck factor can make you complacent. Failure to manage risk leads to substantial financial losses. This can happen when investors become overconfident and make poor investment decisions based on the belief that they can beat the market. For instance, an investment in stock could have given you 2 times or 3 times returns earlier. If you have the same mindset and go all in there, it's also possibility that this may go to zero. This is where you will have to put on your rational thinking hat and take a wise decision. As an investor, it is important to pay attention to general trends of success and failure, such as the advantages of systematic investment planning, asset allocation, and portfolio rebalancing. These strategies can help us navigate the fluctuation caused by the luck and risk in our investment. SIP. SIP involves investing small regular amounts of money into a chosen fund over some time rather than investing a large sum at once. During periods of market stagnation, investors have the opportunity to accumulate more units. Later, during a fortunate phase known as the bull run, these accumulated units can contribute to the growth of their wealth. This strategy can mitigate the impact of market fluctuation and potentially generate more stable returns over an extended period. You can check the blog in our website. We have covered this topic, common SIP mistakes and how to navigate through them, in one of our earlier blogs, and the link is given in the description. Asset allocation. Asset allocation reduces risk and increases return by spreading investments across various asset classes, including stock, bond, real estate, and gold. This diversification helps to offset the negative impact of underperforming assets with the positive performance of others. Therefore, even if one asset disappoints, another one may perform well and compensate for the shortfall. Rebalancing. For asset allocation, you consider multiple factors such as your financial goals, risk profile, and then decide the right asset allocation in your investment portfolio. Say you have arrived 60-40, that is 60 in equity and 40 in fixed instrument. Rebalancing scenario 1, buying the dip. You have decided this ratio in February 2020. Now in March, we saw that stock market nosedive to 8,000 levels. This would have caused your investment value to go down, bringing your desired equity allocation, say, about 45%. Now it is a time to think smart and rebalance and bring the equity debt asset mix back to 60-40. By doing so, you have to buy low. This investment strategy not only helps in bottom fishing, but also make sure you participate in the market, reducing your risk and enhancing luck. Rebalancing scenario 2, selling the rally. Now the bull run for March 2020 has begun to lose steam. At this point, your equity investment may have grown at a good pace, and as a result, your asset mix might have been skewed to, say, 75-25 in favor of equity investment. So we apply the same investment strategy again here. Rebalancing, we sell certain equity portion and buy some fixed instrument like debt fund or bonds, making it back to square one, that is a 60-40 ratio. The fundamentals of these approaches are to avoid pursuing paths of excessive risk and relying solely on luck. It is advisable to opt for the most rational and logical investment approach, which is more dependable and less prone to failure. We would like to conclude that the interplay between luck and risk is essential to financial success. While luck can provide a temporary advantage, Effective risk management is the crucial to long-term financial success. Understanding personal financial goals, risk tolerance, and market condition is essential when developing a risk management strategy. We all may want luck in our investment without any risk, which is impossible. The only way is to minimize the risk and let the show continue. You can also consult with your financial advisor in order to draft an investment strategy according to your financial goals to attain better result in your investment journey. A blog post on this topic is available in the website and the link is given in the description. Hope you like this video. If you have any questions related to this or any other investment option or related to your financial goal, don't hesitate to book a free appointment with our financial planners. The link to the free booking is given in the description box below. Also, will you be interested to attend any insightful investment webinar? Then feel free to register for the upcoming enlightening investment webinar. It is completely free. The registration link for the upcoming webinar is also given in the description box. If you like this video, please give us thumbs up. Also, share it with your social circle. If you haven't subscribed our YouTube channel so far, please subscribe now.